Hello, everyone. A very good evening. I am Naren from Marcellus. I am from the client advisory team. We welcome you to the LCP-RGP webinar. Today, we have with us Ashwin Shetty, the fund manager for both the strategies. It's been an interesting 12 to 18 months in both the strategies, right? So we've made a lot of changes, and I would request Ashwin to take us through all of them. Ashwin, over to you.
Thank you, Naren. Good evening, ladies and gentlemen. So it's been a while we spoke last time. I think the last LCP and RGP webinar was in the month of March. So good to catch up with you guys. So primarily the objective of this webinar is twofold. One is, as Naren said, just wanted to discuss the journey that we have taken in the last 18 months. Obviously, we have spoken about it in the previous webinars as well, but it is good to see what progress we have made, what has been the outcome. And secondly is to discuss how have we positioned the portfolios in the current global as well as domestic economic environment. So just give me some time to share my screen. Yeah, I hope my screen is visible. So first, we start with the first part of the webinar. So what portfolio change? What is the portfolio construction and research coverage changes that we have undertaken in the last 18 months, and how it is helping the return to come back in the portfolio. So first of all, this is the LCP journey from inception broken down into three phases. I think we'll stress on the last part. Obviously, we had a weak part in the phase two between September 22 to March 2024, and the portfolio didn't do well. And we made a lot of changes in the portfolio. And we are seeing that that is helping the returns to come back in the portfolio, as you can see in the last columns over here. So we are matching the benchmark returns in the last 18 months, which was not the case in the previous phase. And similarly, in the Rising Giants portfolio also, the Rising Giants portfolio returns in the last 1.5 years look better than LCP because RGP and LCP portfolios had a lot of differences until about 6 to 8 months back. So some of the stocks like iShare, InfoEdge, Divis Laboratory that were in the Rising Giants portfolio, they did well last year. But as communicated in our earlier webinars, we have aligned both the portfolios, LCP and because we were concerned about the valuation in the RGP portfolio at that point in time. Small caps were looking interesting. And as we speak today, that alignment is complete. So almost all the stocks in the RGP and LCP portfolios are similar as we speak today. So I would say in the last 6 months, the return between RGP and LCP will be more or less similar. Just before we go into what changes we have made in the last 18 months, it's always good to reflect on the difficult time period. We have obviously spoken about it a lot of times, so I'll keep it brief, not go into detail. But broadly speaking, there were two things which impacted the portfolio returns between October 22 to March 24. One is the earnings of the portfolio went downhill during this period. So primary driver of that was threefold. One was the COVID-related demand that the portfolio witnessed that dissipated once the COVID normalized. Secondly, China supply chain came back very, very strongly post the COVID years. Thirdly, the global interest rates because of the geopolitical issues, etc. There are a lot of uncertainties globally. We saw the interest rate rising globally after a long period of time. So all those impacted the demand, especially in the chemicals and the light industrial exports stocks that we held in the portfolio. And at that point in time, until 2 years back, both these sector, chemicals as well as the light industrial exports, they accounted for a bulk of the portfolio allocations. So we'll come to that slide separately. But weakening of the earnings in these two, especially light industrial exports and chemicals, that hurt the portfolio earnings. And second was on the valuation. So valuation and earnings go hand in hand because all of these companies saw a decline in their earnings. So there was also de-rating in the PE multiple that this portfolio commanded.
Sorry to interrupt, but a few people are saying your audio is not clear.
Is it better now, Naren?
Uh, yeah, better now.
Okay. ठीक, I'll try to hold the mic closer to
Yeah.
closer. So second is the PE multiple valuation of these companies had gone up significantly during the COVID, and as the earnings declined for these portfolios, we also saw the multiple derating, sharp derating between September 22 to August, September 22 to March 24. So earnings also went into a decline mode. So did the PE, and hence the returns weakened during this period. I think we did three main course correction to get out of this. So first and foremost was bringing back the discovery mojo back into the portfolio. So most of you have been following us for a while. We have always seen this chart on the left hand side. So one of the important aspects that we ought to, when we started the LCP portfolio, we wanted to achieve was having the portfolio, keeping the portfolio fresh with new stocks, which are not well understood by the market, their earnings potential, their valuation potential. Somewhere during the COVID years, I think the portfolio, we persisted with the existing portfolio stocks for long. So as you can see, between FY22 to FY23, there were not much change in our research coverage, hardly any additions. So the main reason why the research coverage didn't expand during this period was, one is that obviously there's a lot of logistical challenges during the COVID period. We couldn't get out of our home, etc. So there was a lot of logistical challenges surrounding the research that we could undertake. And secondly, the numbers itself, the reported numbers during the COVID period, they didn't depict a true and fair picture of the long term because COVID actually kind of created a lot of, I would say, disturbance in the earnings in a that would otherwise be in a normal course of business, and hence our ability to decipher the earnings potential, the true earnings potential, etc., took a backseat, and hence the kind of the portfolio that we had started in August 2019. I think by 22, we largely most of the stocks continued in that portfolio, despite I would say they being discovered in the market. So that was one reason, and hence, as soon as we recognized this problem in the last couple of years, we undertook a significant expansion in our research coverage. So as you can see, the research coverage almost tripled in the last 3 years. It has almost doubled in the last 2 years, in fact, less than 2 years. So this gives now us a lot of flexibility in terms of wherever we see that valuation is in excess in the existing stock, we have a lot of backup stocks that we can get into. Similarly, wherever we see that the earnings potential is weak, we can dip into our coverage and see whether there are interesting companies over there where the valuation or both the valuation as well as earnings potential looks better than the existing stocks in the portfolio. So this is one big, thanks to our investment team, the relentless efforts of our investment team. This is one we have managed to achieve, and this places us in a very good state right now as we speak. The second course correction which we did, again, this is related to first, is that, as I said a little while earlier, there was a lot of sector concentration in the portfolio until about 3 years back. So, for example, chemicals, BFSI, and light industrials. These three sectors accounted for almost 70% of the portfolio allocation. So this number is basically by the number of the stocks, but I would say key allocation also more or less followed actual allocation. Sector-wise would also follow the same trajectory. So that continued till FY23 end, and hence, whatever downfall we saw in the earnings of the chemical sector as well as light industrial exports, given our concentration in these few sectors, that hurt us badly. But over the course of last 2 to 3 years, we have significantly diversified our portfolio. And as we speak today, none of the sector is accounting for more than 15% of our allocation, no single sector. So it is pretty well diversified. And in fact, this aspect has helped us in the last 3 months. As you may be knowing, last 3 months, because of the tariff issue, and generally again, supply from China, concerns around supply of China, chemicals and light industrial exports again have seen a bit of beating in the last 3 months. But this time we are not faced that kind of brunt which we faced between September 22 to March 24, thanks to the diversification in the portfolio. So this portfolio diversification also is helping us in recent times. And third, last but not the least, is the valuation aspect. One important change which we have done is adopt the IRR-based valuation methodology. So IRR, the full form is internal rate of return. It consists of three components. One is the EPS change. Then what is, for example, if you're looking for IRR over a 5-year period, so IRR would essentially be comprising of three components. One is what is the earnings growth of a stock over that time period, that is 5 years. Secondly, what is the P change, the time we entered the P and the time we exit the stock, whatever P change has happened over that 5-year period. And third is basically the dividend yield, because typically we invest in companies which have more often than not surplus cash on their balance sheet, and hence we should also value that aspect, even though it's a smaller component of the overall IRR piece. So what the shift to IRR methodology has helped us to focus on, instead of being subjective, it has helped us being objective about the valuation. So now we assess the company's potential over a definite time period, say 3 to 5 years, more often than not 5-year period. So what is the earnings that we expect from the stock? For example, what is the scope for market expansion? What is the scope for a market share expansion during that time period? What is the scope for margin expansion, and so on and so forth? We assess this over a definite time period. And second aspect which we check is today, for example, if the PE looks good, but if 5 years down the line, if there is likely to be more competition in that segment, or the growth potential is likely to slow down because of whatever penetration has already been reached, etc. So there is all the more case to assign a lower exit multiple than what the stock is commanding right now. So as a result, that reflects in our P de-rating. So the stock may earn very good, very nice earnings growth, healthy earnings growth over the next 5 years. But if at the time of exiting, the market doesn't have so bright prospect of the stock as it is currently, then that should reflect in a lower valuation multiple when we exit. So that is captured in our PE change or the exit PE. The third element is simple. It is dividend, whatever the excess cash that company has in its balance sheet. There is an optionality value. We just try to be a little bit conservative here and just assign it 1 times value. So we don't give it any more than 1 times value. So all of these components we do for all the stocks in our portfolio as well as for the stocks in the coverage. And the best IRR stocks, they typically make it to our portfolio. So the number which we are showing here is just an illustration. This is not the real LCP RGP portfolio. This is just an illustration. But this has actually helped us tighten our valuation philosophy and framework, the IRR method. And basis this IRR as well as focusing on the valuation multiples, last year we saw that there is a strong run-up in the portfolio and generally in the small caps in the first half, which made us concerned about the valuation of small caps in general as well as some of the stocks in the portfolio in particular. And hence, as we communicated in our earlier webinars, we started trimming positions wherever there were valuation excesses, even exited some of the stocks where the valuation was not within our comfort zone. And we started building cash. And even though there was a small correction towards the end of March 25 because of the tariff, I think we didn't get much time. The stocks again ran up in the month of, in the first quarter of this fiscal year. So I think that is where our cash position reached the peak. But as I will show in the later slide, we have seen some correction in some of the pockets in the portfolio. And hence the valuation multiple has come off now in the last 3 months. And again, we are getting more comfortable about the valuation in the portfolio. And hence, we have started redeploying this cash. So in the model portfolio of LCP and RGP, our cash position peaked at 30% in the month of, by June. in the last 2 to 3 months, we have started redeploying this cash because we are now seeing that there are good valuation available in certain stocks where the share price correction has been ahead of the fundamentals, and hence we have started redeploying cash again. And we expect this cash position to continue to redeploy this cash in the coming months as well. We'll get into more detail in a later slide. But overall, the message of this slide is that we are focusing much more on valuation than what we were doing 3 years back. And the outcome of all of this is that, first of all, we have got the earnings back in the portfolio. So as you can see in the recent quarters, last 4 quarters, we have been able to, both the LCP as well as the RGP portfolio has been able to clock consistently double-digit earnings growth, which we missed actually during this the phase 2 period. So this gives us a lot of confidence. In fact, not only the absolute earnings growth looks good, we are also beating the earnings growth of the benchmark NSE 500 growth. So this gives us a lot of confidence that whatever changes to the portfolio, whatever new additions we have made to the portfolio, that is in the right direction. So this aspect is very important, and this gives us a lot of confidence. And secondly, we have been able to bring down the valuation of the portfolio, current multiple that the portfolio is trading, substantially than what it was around 2 years back. So this red line is basically the long-term average of the portfolio. So as you can see, between November 20 to November 23, or even till March 24, the 1 year forward multiple, so this is an example for LCP portfolio, was trading ahead of the long-term average. But as you can see, thanks to the valuation framework which we adopted, which I talked about, we have been able to bring down these valuation multiples now lower than the long-term average. So of course, some bit of this is also attributable to the cash that we hold in the portfolio. But even if you adjust for cash, this number should look below the long-term average. So particularly in this current environment where there is a lot of uncertainty around corporate earnings, etc., the reasonable valuation at which the portfolio is trading, this places particularly both the LCP and RGB portfolio in a very enviable position. We are very, very confident that this bit will help us, particularly in this environment. So whatever changes, in a nutshell, whatever changes we have made in the last 1.5 years, both in terms of earnings as well as in terms of the valuation, both seems to be working in the right direction. Now the way forward. So there are a few things. One is that we have been talking about our concerns about the broader corporate earnings, and more particularly small caps. So those concerns persist. Secondly, we are seeing the share price correction in certain portfolio stocks because of the uncertainty around tariff, because of whatever is happening in US, H1B issue, etc. So that is particularly impacting the IT services. And we are finding a valuation attractive in a good number of portfolio stocks to deploy cash. So one is on the broader corporate earnings. This chart again we have been showing in our previous webinars. So the moderation in the corporate earnings that continues in the recent quarter also. So the second quarter numbers we will get to know in the next 1 month or so. But as recent as first quarter, the numbers don't look great. So this is the number for the NSE 500. The PAT growth is substantially lower than what it was 2-3 years back. This is more pronounced in the case of small caps, where the earnings growth.
Just worth clearly outlining that this is the benchmark. This is not our portfolio. Our portfolio is doing far better.
Yeah. So this is the broader corporate earnings. So this is for the NSE 500 companies, and this is for the NSE 500 में जो small caps है 250 first to 500. So this is both for the NSE 500 as a whole, as well as particularly the smaller companies within the NSE 500. The earnings growth has seen significant moderation than what it was 2 years back. And again, we have written about it a lot, so no point repeating. But broadly speaking, I think there are concerns about the middle class consumption, about the government capex, and so on, and that concerns persist. So this is a challenging from a broader corporate earnings perspective. In fact, we have seen that the consensus, because of this weakness in the earnings, the consensus have been consistently downgrading their earnings. So this is the consensus earnings cut since March 25. And this has been more pronounced in the small caps. So this is almost more than 10% cut in the FY27 earnings since March 25. And we believe that this will continue, because when we look at many of the small cap estimates for FY27, they still look on the very higher side, very optimistic. So we believe that the journey of consensus downgrading their earnings, that will well continue in some time to come. Within our portfolio, we have, as I said, substantially brought down the light industrial exports and chemical exposure in the last 1.5 years. Nevertheless, we still have some exposure. For example, 25% of the portfolio still has exposure to chemicals and light industrial exports. And this is one pocket where we have seen some correction in the last 3 months. Exports, as all of you know, that because of the tariff additional tariffs imposed by US on India, that has created a lot of uncertainty in the exports stocks. Chemicals also, we see that China, because is seeing again a renewed dumping of China in the chemical space, that is impacting the pricing. But the good part is that our exposure now is substantially lower. So as a result, the impact on the portfolio has been very, very contained, I would say, compared to what it would have been if I had not done the portfolio changes in the last 18 months. But one good thing within this is that many of our portfolio stocks, I think the reaction has been much more than what it ought to be, fundamentally speaking. For example, one of the stocks we have in this portfolio is which has exposure to US of only about 10%. So maximum exposure is of 10%. But the share price correction has been the north of 15-20%. Similarly, one of the stocks which has seen significant correction north of 20%, but they have a manufacturing arm in USA, and hence we believe that they should be largely be not impacted by the US tariffs. But I think so we are seeing that pockets where the share price correction has been ahead of what it ought to be fundamentally. And hence, we are now finding opportunities to deploy cash in those sectors. Even the IT names, for example, which we own, these are mid-cap IT companies. So these are not large-cap IT companies. One good thing about the mid-cap IT companies is that they are not so impacted by whatever change at the overall level, because here we are betting on more about turnaround stories. Because of the new management, because of the new owners, and hence whatever is impacted the overall industry level, it can be more than made up by the market share gains that they can do. And hence we believe again in the IT names correction which we have seen, that is not unjustified, and hence we are finding the we are using the cash to deploy in these names. So this is just at the overall portfolio level. As I said, we have used the correction in the last 3 months to deploy the cash, and hence the model portfolio cash, which was at about 30% peaked at around June end, that has come down to 25% odd at the September end. And I believe that we will continue to deploy more and more cash. And this is what we actually, one of the objective of holding cash or building cash in the portfolio is also to prepare for this scenario. So one objective was to mitigate the impact because of the high valuation generally in the small cap space. But another important objective is also that whenever there is correction in good quality names, we will use that cash to deploy them at a low valuation. And in fact, that is now playing out in the portfolio. So this is where, in summary, I think in summary, we have done a lot of changes, orientation in the portfolio in the last 18 months. That seems to be giving results in terms of bringing back the earnings in the portfolio, in terms of maintaining the valuation within the portfolio at reasonable levels. And we are using the current environment to our advantage by redeploying cash. So cash is a very big armoring that we have. We are redeploying this cash in good quality names that have seen corrections ahead of what it should be based on the fundamentals. So I'll stop here. I think we can start.
So Ashwin, I'll fire the first few questions. I'll pick them up from the Q&A box and fire them at you. You can hear me, Ashwin?
Yes, sir, I can hear you.
Yeah, so Dharmendra Chauhan ji is saying the last 3 months is not a long enough time frame. What about long-term underperformance? So do you want to just go through that 3 phases of performance again? Because I agree with Dharmendra ji, last 3 months is not really the relevant horizon. Just it's worth reiterating the 3-phase performance of LCP and how after the pounding of 2022-23, absolute pounding of 22-23, you tried to set the ship up going again.
Yeah. So this is the entire journey of LCP over the last 6 years. So it's actually like a movie. So first 3 years we did very well. Actually, as you can see, not only the absolute return but also the outperformance over the benchmark. So many of our stocks actually went on to become multi-baggers. So be it Alkyl Amines, GMM Fodler, Moltec Packaging, and so on. So we did very well in the first 3 years. But many of these stocks actually, ironically, performed poorly in the phase two, which I talked about. So I think 2-3 things which impacted, again to repeat, in the phase two was we had heavy exposure to chemicals, right? So this sector did very well during COVID when China for chemicals during the COVID. The whole scenario changed once the COVID ended. So China came back strongly in the supply. The demand related to COVID products that dissipated, and hence the entire demand supply equilibrium it reversed than what it was in the COVID period. In our mind, why we persisted with the stock was that we believed COVID had changed the paradigm. It will make the stronger players stronger, and we believed that COVID will continue for a while, and hence we were slow to kind of bring down the positions of these stocks. Similarly, on the light industrial exports, so the companies which we had picked, they had done very well for long period of time. They continue to do well during COVID period also. But during FY20, this calendar year 22-23, one phenomenon which we observed was that the increase in the global interest rates, right? So as a result, a lot of dealers, distributors in the export markets, they went lean on inventory. So as a result, the demand for a light industrial export companies, they suffered, right? And this is again the phenomena which global interest rates went up unprecedented levels, right? Which we have not seen the previous 10 years, 15 years, 20 years. So again, this was something not anticipated by us. And another important thing during this period is that we always held a very concentrated position in Natil Champs, right? So we used to have 14, 15 stocks, which meant that for the top conviction bets, we used to own 8 to 10% of the companies, and this also made us difficult to get out of the stocks. So we had done all that rectification. So I said, like, now we own much more diversified number of stocks, much more diversified number of sectors. I think the maximum position that we have in the portfolio per stock right now is, I would say, not more than 4.5%. Similarly, we have a lot of coverage stocks now than before 2 years, 3 years. So now we are much more better placed than what say the phase two period. So I would say in whole these 6 years, if you remove this phase two period, I think it looks all good, right? But this was the period which actually impacted.
I think more importantly, Ashwin, that was the period that we learned. We learned that we have to broaden coverage. We learned that we have to diversify the portfolio, and that we learned that we have to be careful about valuation. So you learn from your difficult periods as a fund manager, and the same applies to us. Archit has a question. Archit is saying that foreigners are selling year after year. Earnings growth in India is slow at the index level. You've shown just how weak earnings growth has been for several quarters. Valuations are expensive at the market level. Is our Indian retail investors misguided? And if so, if Indian retail investors are misguided, given that foreigners are selling, valuations are rich, and earnings growth is consistently weak, then why are you putting more cash to work? Shouldn't you be going back to holding more cash?
So again, that is kind of taking I think point actually, because we always believed and we continue to believe that the stock price has to be driven by earnings growth. If the earnings growth is weak, I think the valuation of the share price has to come down. Which you saw, right? For example, in the last, I would say, if we divide the journey of small caps, Indian small caps in the last 18 months, last year first half, from April to we don't have the chart here, but I'm just going to this slide. Yeah, so last year first half, the small caps they did well, but second half was a very miserable time, right, for small caps. Small caps. So it's not that it's been one way up straight, particularly in the last 18 months. We have seen ups and downs in the small cap space. But again, in the last 6 months, I think there has been a euphoria built in the small cap space. But you never know when things can change. But our strong belief and conviction is that we have to back the earnings growth in the stock. I would say maybe someday the valuation of the share price will eventually catch up. But we will personally not like to invest. I personally would not like to invest in stocks where the earnings is weak, but which is the flavor of the season or which is favored by the retail investors. I would like to stay away from that.
So several clients, Ashwin, are trying to reconcile the figures you're giving on the screen vis-a-vis the cash balance and whatever they've seen in the statement. So some are saying cash in their portfolio is 32%. Some are saying cash in their portfolio. So can you just explain to them what the current cash is and how people can reconcile that number with whatever cash balance they're seeing in their statement?
Yeah. So the cash balance which is showing in the chart is more of the model portfolio. Obviously, there is always a difference between model and actual portfolio. But eventually, I would say it aligns. There is an alignment which takes place between actual and model portfolio. For example, if we decide to buy a stock, I just give you a hypothetical example. Suppose today the Marcellus investment committee decides to buy a stock. We will, for example, assign 4% allocation to that stock. So it will go out of my model portfolio cash balance. So my model portfolio cash balance will look lower. But given we are dealing with small caps, illiquid stocks, we will not rush into buying that stock on the first day because we will be unnecessarily creating a huge price impact. So in the actual portfolio, the position building will be quite gradual. Say, again, these are lessons we learned during that phase, that we should have patience in terms of building the position rather than being aggressive.
I think so we should leave it at that. Just say that that's enough. That we will gradually build the position.
So similarly, the exit may be model portfolio may also stocks nikal jayega, but in actual portfolio,
I think the reason we don't want to say more is, folks, that it needlessly compromises your portfolio price impact, because the more clarity we give the world on how much cash we hold and how we will deploy it, the more the price impact is when Ashwin builds the position. But rest assured, he is putting more of your money to work. Now, Shrikant has a So Shrikant has a very interesting question. So he's saying that aren't you effectively timing the market here, right? By trying to gradually deploy cash, aren't you timing the market? And since we believe we've always said that that timing the market is hard. Why are we then following this line of attack where, given that valuations are super expensive, have gone into cash? So what do you have to say to Shrikant? This point that holding cash balances is akin to timing the market.
No. So basically, we are strictly following the IRR approach. So wherever, for example, the entry P is high and hence the stock is not coming within our desired rate of return, I think we are waiting for a better entry price, for example, in that stock. And we have seen in the last 18 months, because the market has been volatile, patience has paid us positively. Actually, wherever we have been patient, I have seen that the prices have come to that level, desired level. But again, we may miss some of the opportunities, but by and large, I think if you follow the valuation discipline, trim the stocks where the share price movement has been ahead of the fundamentals. Actually, we have seen that in the last 18 months that has paid us handsomely.
Nikhil has a very specific question. Nikhil is asking you, what is your RGP or LCP EPS growth estimate for the second half of the current fiscal? So how fast do you think portfolio earnings growth will be in the second half of the current fiscal? And if you can help him contextualize that by comparing that with the benchmark's earnings growth, that will be helpful.
Yeah. So Nikhil, I would say so for almost 2/3 of the portfolio, I think we should expect the similar kind of earnings growth, that is mid-teens to high-teens earnings growth that the portfolio has been posting for the last several quarters now. However, I would say for some of the 25% of the portfolio, especially in the chemicals and the light industrial exports, I think because of what has happened in the last 3 months, I think those pockets will see some weakness. But again, as I said, like for most of the stocks, there are mitigating factors in place. For example, either the US exposure is limited, or they have a manufacturing on the US, and so on and so forth. And hence, I would say even that stocks, a large part of those stocks should see an earnings recovery going forward. But by and large, I would say if I had to do a weighted average, I would say this 16% may go down to say 12 odd percentage in the second quarter results. But again, come back to mid-teens growth, I would say by fourth quarter of FY26. And the broader corporate earnings, I don't see this going beyond the numbers which you can see in the screen, that 10% mark. So there's a lot of struggle to reach double-digit growth in coming quarters.
Okay. Srikanth is asking about the expansion in research coverage, right? We've historically said that we do extensive amounts of research and we have a discovery process for finding stocks. He's asking for more color on how do you actually go about doing research, Ashwin?
Yeah. So this is, of course, a small caps focus on LCP. So one is that of course, we run a lot of, I'll not say a lot of screen, but screen which focuses on the cleanliness of the account, basic checks like what is the ROC, focusing on both the absolute ROC, is it greater than the cost of capital, and similarly whether we are picking the companies which makes higher ROC than its peer in the sector. So this is more on the quant side, and then we do a lot of deep dive research, understanding what is the drivers of this ROC. Why does the company makes better ROC than its peers? Then, of course, this involves reading a lot of secondary research on the stock, annual reports, and speaking to a lot of people in the industry. Once we are able to understand what are the drivers of the return on capital employed, then we discuss or rather take a call in next 5 years, 3 years, is this going to continue, or are there risks to this ROC? For example, is there a big competition emerging? Because most of these are small caps, no? So they have been not tested enough, I would say, on the competition, because invariably they are operating in a niche space, and hence they have largely been not captured the eye of big players. But if there is an impending big entry in the next 3 to 5 years, then we have to decide whether that ROC can sustain, whether the margins can sustain. So there's a lot of research which goes in, and basis that then we come up with the what is the expected earnings growth, what is the exit multiple, and so on. And basis that we come at IRR for the stock. And of course, it's not that plainly it's mechanical that high IRR we select. Of course, we have to also decide the risk, and a lot of other things go into. We have to see the diversification. For example, if you have 2 stocks already from the sector, whether adding a third stock, even though it shows a good IRR, whether it will not help on the diversification, etc. So these are the aspects.
I think in that context, this question on Vijaya, some of our clients know that Vijaya has been purchased by some of the larger portfolios in Marcellus. Some of the larger strategies in Marcellus have bought Vijaya. Since you bought it, made money from it, I think it went up 40-50% on you, I remember. Ashwin, Vijay went
Yeah.
50%, but then you sold it, right? It went up 50%, you sold it.
Yes.
So given that other larger portfolios in Marcellus are buying it and you don't have it, what do you have to say for yourself, Ashwin?
Of course, one is that history on Vijaya, we bought it at very good levels because it was one stock which had we actually looked at post-COVID. It had corrected significantly. I think it had gone down by 20-25% levels. So we bought it at reasonably good level, and the stock doubled on us once we bought it in the next 1.5 to 2 years. And at that point in time, the valuation looked, for example, I think if I remember correctly, it was almost 55-60 times. Significantly, I think it had crossed Dr. Pathlab's valuation at that point in time. And then Sang is sticking to sell the stock. Of course, the stock has continued to do well. But again, every strategy here in Marcellus has a different kind of coverage stocks, right? Coverage stock, for example, CCP has its own, one is the size of the company, similarly it has its own set of coverage stocks. Similarly, LCP, RGP has its own set of coverage stocks. So we have to decide how does Vijaya stacks up versus the other coverage stocks in the respective strategies and of feature in the top 30. So we are now holding close to 30 stocks in the portfolio. So it doesn't feature in the top 30 within the coverage stock of the LCP and RGP portfolio, and hence we have abstained from investing in Vijaya in the LCP and RGP portfolios. But maybe in other coverage stocks, basis in the other strategy, basis their coverage stock, Vijaya would be featuring in higher in the order, and hence they have taken position in Vijaya in those strategies.
Sriporna has a question for you on Tarsans, Ashwin. So Sriporna is making the point that Tarsans underperformed, the stock underperformed, the business underperformed for 3 years. We held it for those 3 years and then we exited. Was it the right decision to hold it?
Yeah, in hindsight, actually, yeah, it's not been a right decision to hold. So one is, of course, I think as with some other portfolio stocks, I think here also the COVID demand dissipated and hence it impacted. But other thing, I think, which came out of the blue was the company went in for massive expansion. So while the core earnings, I would say, till EBITDA level, we are seeing decent, steady growth in Tarsans. One thing which hit the bottom line was because this expansion all got commissioned, but at the revenue side, there was no uplift. And hence, a result, the depreciation cost went up significantly, particularly in the last 1 year. And this actually impacted. Otherwise, the earnings of Tarsans has more or less steadied till the EBITDA level, but the depreciation and also the interest cost that has come out of the blue in the last 1 year. As a response, we had cut down the position in Tarsans significantly. So around one time, it used to be one of the top position in our portfolio, almost 7-8% of our portfolio. As we speak today, it is almost in, if you say, 1.5% of the portfolio. But yes, I would admit that there has been this has been a setback. Tarsans has been a setback in the LCP and RGP portfolio.
Srikanth is asking, he's saying that in the early days of Marcellus, you used to engage rigorously, proactively with management teams and try to help them. Is that approach still followed, given that the portfolio is larger and the firm is larger?
Sorry, we are losing you, but I understood the question. I would say, yeah, that continues to be one of the objective. Because at the end of the day, here also we are not kind of left behind the discovery that, in fact, this is coincidentally the same chart. Discovery remains very much the objective of the portfolio. And one way of discovery is also helping one of the ways that companies can get a valuation re-rating is also helping them provide a lot of comfort, for example, to the institutional investor in terms of disclosure, in terms of other aspects. So this very much remains part of the agenda. We continue for every portfolio company, we continue to engage with them and how well can they improve the disclosures, transparency to the investors. In fact, not so much for PMS, but for our RGIF, this also remains one of the regulatory agenda, stewardship, etc. So very much remains in our radar.
Naman is asking, why do you have so little by way of mid caps in your portfolio? Your portfolio has a small cap. Why is that?
Okay, again, its voice was cracking, but I think I got the question.
So Naman is asking, why does the portfolio have a small
Yeah. Okay, so one default reason is that again this is a discovery portfolio where we are looking at valuation and earnings asymmetrical, getting valuation and earnings asymmetry. I think the probability of that is higher is when we go down the market spectrum, right? Because mid caps they are largely, I would say, much more discovered. And hence, if you have to find a company relative, I think the probability of that finding is in the small cap space. In fact, Rising Giants used to be a largely mid-cap portfolio until about 6-8 months back. And as we communicated in our earlier webinars, we have aligned both the LCP and RGP portfolios as well. But I think the objective of the strategy is well served by looking more at the small cap space. And again, I think this question is coming because we talked about that generally the small cap is trading at very high levels. So I think the client is finding it a little bit ironical then why are we looking at small caps? But I would say there are pockets within the small caps where the valuation is still very attractive, etc. And that is where we want to play in that pockets of the small cap space.
And last question, Ashwin. Shrikant is asking, how do you decide whether a stock which is held in one of other Marcellus portfolios, say KCP or CCP, how do you decide whether it should be held in LCP as well?
Yeah, so honestly speaking, the ICs, there's a different ICs for different products. You need to be right because need to be different because every product has its own objective, client objective.
IC क्या होता है लोगों को समझा दो.
Sorry, investment committee. So every product has its own philosophy, its own client objective. So it's not necessary that if one stock serves that purpose in one portfolio, it needs to be served in other portfolios. But yes, we do get a comfort. For example, if you are holding one stock, for example, say Kings of portfolio for the last 3 to 4 years, it does give us comfort that because we have met the management, we would have some degree of conviction. But end of the day, the decision is not based that because it is held in Kings of Capital that we should also hold it in the Little Champs. It has to be on its own merit, meeting the objective and serving the purpose of the LCP strategy. I hope that answers the question.
It does. Thank you very much, Ashwin. And sorry, folks, I couldn't show my face because I'm sitting in a traffic jam for the last 2 hours in Mumbai. But I think Ashwin's answered everything you put to him. Thank you very much to all of you for joining on this Diwali Eve, and happy Diwali to all of you. Thank you, Ashwin.
Thank you, Saurabh, and happy Diwali to everyone. Thank you.